Lesson 10-1 is Accounting for Sales on Account. Our learning objectives are explaining the relationship between the accounts receivable ledger and its controlling account and recording sales on account using a sales journal. A merchandising business gets its revenue from the sale of merchandise. The amount a business receives from the sale of an item is called the selling price. For a business to survive and grow, it must earn a profit. The amount a business adds to the cost of merchandise to establish the selling price is called markup. So you take your cost of merchandise plus your markup and you're going to get the selling price. The share of the total revenue from the markup pays for expenses of a business, and it also returns some of the profits to the owners. A sale of merchandise may be for cash or on account. Regardless of when payment is received, the revenue should be recorded when the sale is made, not on the day the cash received. And this is our concept, realization of revenue. For example, on June 15th, 3 Green sold merchandise on account to customers. The customers paid 3 Green for merchandise on July 9th. 3 Green records the revenue on the date of the sale, which is June 15th. Delgado Web Services uses a general ledger account to record transactions with each customers. This method is not practical for businesses having large numbers of customers. 3 Green maintains a subsidiary ledger for its accounts receivable. An accounts receivable ledger is a subsidiary ledger containing all accounts for the charged customers. So again, last chapter we had accounts payable ledger, and that was a list of all of our vendors. If you look at the diagram here, the total amount owed by these customers equal the balance in the controlling account. So if you take all of those numbers from your customers, which is in your accounts receivable ledger, you add them up, they will total up what your controlling account, accounts receivable, has in it. So this is the total amount of all your customers, what all your customers owe you. Here is the individual amounts. Accurate account receivable ledger provides a business with information necessary to ensure the collection of money owed the business with the information necessary to ensure the collection from all its customers. Remember, accounts receivable is an asset with a normal debit balance. You will also notice the numbering of your vendors. The 1 means it comes from the first account group in your chart of accounts, which is assets, and then they are alphabetized within the ledger and numbered by the tens. Subsidiary ledger form contains the same columns except the credit balance amount columns. If you look at it here, they have the same column headings. The only thing that is different is our balance column. Remember, accounts receivable has a normal debit balance, so therefore your accounts receivable ledger accounts will only have the debit balance. If you look also here, this situation, on November 1st, 3 Green prepared a new page for Skinner College with the accounts receivable ledger, showing account balance was $3,060. So when they prepared a new form, it was a transfer of a previous account form. You write the account name, the account number, the date, and in this situation, we would write balance because we're bringing the balance from a previous page. We would place a check mark in there because it's not posted from any journal. And then we would record the balance, and we would be ready to use our subsidiary ledger form. With sales comes sales tax. 3 Green sells to a variety of customers. They sell to individuals, business, schools, and churches. Laws in most states and some cities require a tax to be collected from customers for each sale. It's like when you go to the store, You pay for your product and you pay for a sales tax. A tax on the sale of merchandise or a service is called a sales tax. Sales tax rates are usually stated as a percentage of sales. Regardless of the tax rates used, accounting procedures are always the same. Businesses must file reports to the government and pay the amount of tax collected. They must report, and you have to keep this separate, you have to report your total sales and the total sales amount that they've collected. The amount of sales tax collected is a business liability until it's paid to the government or agency. So as a business, you sell a product, you receive sales tax. You have to keep track of that sales tax, and then eventually you give all of that sales tax to the government. You are not making a profit on sales tax. You are collecting it, and eventually every month or every 3 months or every 6 months, whatever your payment schedule is, you will make payments to the government. So again, it is a liability because you owe the government the sales tax that you have collected. So therefore, again, it is a liability. Sales tax amount is recorded in a separate liability account called sales tax payable. And again, you see this word payable, and therefore you know it is a liability. So sales tax payable, a liability, it increases with credits, it decreases with the opposite side. A sale of merchandise to a business that expects to resell the merchandise to its customer is normally exempt from sales tax. So as a business, if I buy merchandise and I'm going to resell it, I don't have to pay the sales tax. Only the final consumer of the product is normally required to pay sales tax. So once I sell it to the consumer or my customer, they will pay the sales tax. A state can choose to exempt from sales tax some types of merchandise or sales to certain types of consumers. Nonprofit organizations such as churches, schools, and government agencies are usually exempt from paying sales tax. Sale of necessity, there are certain products that are not charged sales tax: food, clothing, and medicines. And again, it just depends upon the state and the state laws. A sales journal is a special journal used to record only sale of merchandise on account. And you can see that it has 3 special amount columns: an accounts receivable, a sales, and a sales tax payable. With these special amount columns, each sale on account transaction can be recorded on one line of the sales journal. When merchandise is sold on account, a sales invoice is prepared. And again, remember, this is our source document, proof that it occurred. It's also called a sales ticket or a sales slip. To the seller, if I am selling the merchandise, it is a sales invoice. But when my customer gets this, it is a purchase invoice to them. Okay, but to us, it's a sales invoice. 2 copies of the sales invoice is usually prepared. One goes to the customer, which is your original copy, goes to the customer, and the second, which is a duplicate copy, will go used as a source document for filling orders and for the accounting purposes. You will also notice on here there is a sales tax. 3 Green lives in a state that has a 6% sales tax, and we'll see how that's figured out when we do our problem. You'll also see each invoice, since these are yours, they will be in numerical order. Three Green sells on account to businesses that have previously applied and been approved to purchase on account. All other customers must pay cash or use a debit card. So remember, our sales journal is used only for sales on account. If you're selling for cash, that's another whole journal. Okay, so if you look at this transaction, sold merchandise on account to Will's apartment, $454.50. So that was the merchandise, the total of our merchandise, plus a sales tax of $27.27. So again, to figure out our sales tax, we would take, if you look up here, we would take the amount of the sales times our sales tax, and we'll come up with $27.27. The total then would be our sales plus our sales tax, our total of $481.77. So that is our transaction that we are going to record in our journal. The three accounts affected: accounts receivable, which is Wells Apartment, our sales, and our sales tax payable. The total amount of our accounts receivable is going to go up, the amount that we're going to receive from our customers at a later date. So that's going to go up for the total amount, because remember, our customers have to pay for the sales and the sales tax. So they owe us $481.77. Sales is the total amount of our sales is also going up. So we're going to credit sales for $454.50, the amount of merchandise that we sold. And our sales tax payable, a liability, is also going to go up. The total amount we've collected from our customer and that we owe to the government. Again, that's why we record it as a payable. So to record this in our journal, we write the date, as always, the customer's name. Okay, we see we have an accounts receivable. We have to identify our customer's name so that we can bill them. Our invoice number. Accounts receivable, the amount that the customer owes us, the sales, and the sales tax payable. If we go back, I'm just going to flip back to the purchase invoice, okay? Remember, this is the amount of our sales tax payable, and our accounts receivable that our vendor, Wells Apartment, owes us. And it's sales invoice $498.